Now to shift gears entirely and look at the latest craze of meme stocks, which is fun because there's some new players right now and part of the conversation. Welcoming in now Dave Mazza, the CEO of Roundhill Investments. Dave, thanks so much for being with us. I mean, what a week. Kohl's chart, first of all, is ridiculous, but also Opendoor. Now we have Krispy Kreme. I mean, walk us through your thoughts on some of the meme trends we've seen this week.
Well, it's interesting. In many ways, meme stocks have never gone away, but we're clearly seeing this week kind of a huge pushback into what we'll call meme 2.0, with a lot of behavior that reminds investors like myself of 2021. So started with Opendoor. This is a company that flips houses, has certainly been under pressure with what's going on in the housing market, trading below $1, potential delisting. And then all it took was a hedge fund manager to come out and label it a 100-bagger. And the stock rallies 100%, 200%, 300%. And now we're seeing that come off. To your point, Kohl's was another one, Krispy Kreme. But really, they're all emblematic of the fact that I think retail investors, especially when they identify a stock that has high short interest, in some ways low float, then they can take advantage of it, particularly with sort of the Reddit forums and the potential for everyone to get back on board with a particular name. And it certainly helps that a lot of these companies, particularly your Kohl's and Krispy Kreme, are household names and they're sort of well loved. And I think in some ways people feel like, fundamentals aside, these stocks shouldn't be trading at such low prices.
Well, and right. I mean, I think that is the concern and the risk that someone that is so driven by fundamentals like myself, that is where I look at these names and I say, hey, the common grouping here is they are somewhat all failing businesses. Not to say they're not, well-known brands to your point, but does that then give you any concern when you're looking at like trading or investing in these names? Because to your point, the meme stock culture has not gone away, just has sort of rotated away. But also all of these names have such high short interest.
Yeah, no, I think there's sort of two areas here. So if if an investor is an active trader and they have an appreciation, understand how to use options, meme stocks actually might be great for them, right? If you're comfortable taking on that risk, if you're kind of getting in later on the wrong side of that. On the other hand, it's definitely a sign of the potential for rampant speculation. But that actually could be countered with the fact that, a name like Alphabet, which is the cheapest Magnificent Seven stock, is, let's call it, trading around 20 times forward earnings. So we're not seeing like broad-based speculation across the market, particularly because there's still kind of economic questions. But what we are seeing is these pockets of speculation. And that actually can get out of hand pretty quickly because you need to be able to rotate really swiftly, right? So this week was your Opendoor, then your Kohl's, Krispy Kreme. Who knows what tomorrow is going to bring? But if you don't really have the potential to be nimble, you're probably going to want to stay away from here because you certainly could get caught on the wrong side of it.
And I know that people have made the argument of how is like Roaring Kitty, for example, any different than, a major executive or an analyst call. I mean, it's just someone basically making a speculative decision that others are following. So do you tend to follow some of the retail crowd's noise, or do you say, it's maybe something to better left to maybe wait till the dust settles here?
Well, I think in today's market, as much as fundamentals are important, right? The CFA textbooks and MBA textbooks don't talk about sort of speculation from Reddit communities and Discord, right? Or even Roaring Kitty. But I do think investors and even institutional investors can't ignore the fact that retail makes up a significant portion of today's equity market. The whole book was written called Dumb Money for a reason. That's what retail was considered. And I think it's proved, especially this year, that retail isn't dumb at all. And I think it's a really mischaracterization of that space. I think there are times, like any area, that there's probably pockets where people will say, what the heck is going on here? But at the end of the day, I do think investors need to be aware, particularly if they're either going long or shorting a stock that has tons of short interest, that has a potential for a squeeze pretty significantly, especially because of really the access that investors now have to kind of short-term tools, whether they're one-day options, zero-day options, what have you, that markets can move at a much more quicker pace. We, of course, saw it first with your Gamestop and AMC, but now it can kind of happen in any pocket across the market and with names that people may have not considered. But they all do share those kind of similar characteristics. So if someone is looking to get sort of into a name, whether they're long or short, you can't ignore some of those realities.
I completely agree. And I've always said you can't ignore the Wall Street Bets crowd because they're powerful. And it's one I follow because I just think it's interesting. And I like these new players in the meme craze, of course, like your Kohl's, your Opendoors, Krispy Kreme, instead of maybe all of the focus being so much on GameStop, AMC, which I also do like to look at time and time again. But we so appreciate it and all of the great thoughts on what has been a busy week already. Dave Mazza, appreciate it, CEO of Roundhill Investment.